Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. And we're back. It is March 25th. Welcome to the Long-Term Investing Podcast. I'm joined with Ernest Wong, or by Ernest Wong. I don't know. Ernest is here, though. Hi, Ernest. And we're going to talk today about Canadian energy. We'll throw in some tariff stuff just because it's so much fun to talk about. Maybe we'll talk a little bit about an upcoming election in Canada, talk about the markets, whatever comes to mind. But before we get to that, we have some business to attend to, and that is for you to give us 5-star reviews on Apple and Spotify, and give us likes on YouTube and subscribe. And of course, if you need any financial services, any wealth management solutions, please reach out to us. We'd love to have you as a client. And for those clients that are already clients, thank you. And always feel free to reach out to your portfolio manager if you have any questions, especially about our podcast. So with that, let's start with the month of March is going on a long time. I feel like March is... Yeah. It's been a stressful one for investors. If you listen to our last podcast, I think we talked about how we behave ourselves during market corrections and pullbacks. The S&P 500, I think, officially hit a correction. NASDAQ, more than a correction, maybe even a 20% pullback. The TSX, not as bad. Very interesting, Ernest. The TSX has outperformed the U.S. markets because of A, its exposure to gold, and B, maybe has some fewer exposures to some of those growth tech companies that got really hurt, right? If you look at the components of the S&P 500, the S&P 500 is actually up year to date, excluding the Magnificent Seven. Right. Reversal of kind of last year, where if you only own the Magnificent Seven, you were a genius, and you avoided all other S&P 500. It worked out pretty well, but. What goes up must come down, and vice versa. So that's kind of the market we're in today. Still, it's been recovered a bit. We still have really no clue as to what's going to happen April 2nd with these tariffs. Yep. I think they still don't know, the Trump administration. So that will add some more uncertainty. I think the other overhang on the market right now is obviously the concern about will these tariffs lead to a recession or a slowdown in growth, and how will that impact earnings? These are all fair worries and concerns. Hopefully there's a well-reasoned end game to this, and I think ultimately whoever's president, I think everybody wants the stock market and the economy to do well, and everybody to be employed and inflation to be low. Yeah. So we're cheering for those things to happen over the long term. In the news in Canada, of course, we have an election coming up. Many Canadians don't understand that in Canada, you don't vote for the prime minister, you vote for the party, right?
I think Canadians don't understand, or Americans don't understand?
I don't know. I don't know if anybody understands it, right? So people are saying, when is the inauguration of Mark Carney? Well, he's not going to be inaugurated. He's the leader of the Liberal Party. The Liberal Party is inaugurated as the leaders, right? So we have an election coming up, April 28th, I believe. Your thoughts, your takes, and how it relates to the stock market, if anything?
Probably very little. I think there's been a clear focus for both of the main parties, the Liberals and the Conservatives, on things like energy security, things like improving affordable housing, improving the productivity of the country, and each party is going to have their own nuances to or policy prescriptions for these kinds of things, but I think the general direction is in both parties are generally going in the same direction.
I think so. I think you're seeing a very similar overlap, especially for some of the economic or business policies. Possibly tax cuts, possibly removal of capital gains, removal of this carbon thing for consumers, more infrastructure spending. So it seems that both the Liberal and the Conservative Party are looking, well, A, we need the growth, and B, we can't rely on the United States given the flip-flopping of the tariffs. And so I think this is a good thing to kickstart Canada. We're not going to give you our political opinion on whom you should vote for. You'll have to look at the issues that make sense to you, and you keep in mind that the person that represents you is a person in your riding, your MPP, not necessarily MP. What does MPP stand for? Anyway, your member of parliament, that's the person that represents you, not necessarily you're voting for the prime minister. So lots of things to think about, and we're excited for a new direction for Canada, but we have to get over some major humps first.
You see in the Wall Street Journal, I think yesterday, they said that Canadian travel to the U.S. is down 11%.
Wow.
And it's hard to, maybe some of that's the U.S. dollar, but also noted patriotic sentiments among a lot of the Canadians.
Well, I mean, you hear it anecdotally, people saying, I was going to go to Florida, but I'm not going to go, or I was planning a trip to Arizona, someone told me, and they said, no, now we're going to go see Nova Scotia. So with the Canadian dollar where it is, Canadian dollar is actually up year to date, but year over year down a meaningful amount. And of course, things can change a lot on that Canadian dollar depending on the tariffs and how the economy plays out. But I don't feel for anybody. I don't feel, if anybody going to the United States, I feel for them because of the cost for Canadians is outrageous, right? So maybe spend some more money in Canada. Just too bad we don't have a warm weather destination here.
Come to Toronto to visit us.
For sure. We'd love to see you. So the election is happening. Ernest, do you think, I guess this relates now to the energy policy, and we're going to talk quickly about that before we talk about our energy stocks. But is there been any articulation from the Conservatives or the Liberals energy policy that their plans are going forward, or any changes?
I don't think there's been anything too concrete. I think the reality is that even though under the Trudeau government, the pace of the projects has probably gone a little slower than you would have hoped, the reality is it takes a long time and it's a difficult process to build new pipelines.
For sure.
And so, there might be some streamlined permitting and those kinds of things that allow projects to move ahead a little bit quicker, and maybe some more, I would say, provincial collaboration to really work together to figure out all these different nuances. But I expect that whoever ends up being the next prime minister, that we're going to get moving on these projects.
I would agree, and I would hope that would be the case. In the meantime, LNG Canada looks like it's going to start its first shipping sometime later this summer.
April.
Okay. So next month.
Yeah.
So that's fantastic news. And there's plans in progress to add more LNG plants in Canada. Of course, none are under. Are there any other under construction at the moment?
No. So there is a floating project. I can't pronounce the name of the project, but there is a floating LNG facility that is connected to LNG Canada. There is down the road. There's LNG Canada Phase 2.
Yep.
So there are projects in the works.
And for those that don't even know what we're talking about, can you explain why liquefying natural gas is so important to Canada and what the benefit is?
Yeah, so the main benefit of building LNG facilities is that it allows Canada to be able to export its natural gas to Asian markets, essentially. I think of places like Japan, South Korea, and even China, where historically, they need natural gas.
Yeah.
And this is gas that is often displacing coal usage in these countries. And they need natural gas to, live their lives. And Canada building LNG facilities allows them to access Canadian natural gas from Alberta. And this would be the shortest distance for natural gas versus other places like the US Gulf Coast, for example.
And is there an opportunity at some point for Canada to sell its natural gas to Europe as well, or is that not as realistic?
It's harder.
Yeah.
Well, first of all, today Canada actually can export natural gas to Europe, just not throughout our own borders.
Yeah.
Like Tourmaline, for example, like they do have contracts that allow them to sell to Dutch benchmark pricing in Europe. But I think it's a little bit more difficult for Canada to be able to export gas to Europe because of the geographical constraints of moving the gas from Alberta to the Atlantic coast.
Yeah.
And then secondly, like Europe gets most of its gas from Russia and Qatar and Saudi Arabia and those kinds of regions in the first place, where there's geopolitical issues there, but ultimately at the end of the day they still need their gas.
Yes.
And so I think the need for Canadian gas is a little lower than in
just
Asia.
Geographically where we're situated, but the demand from Asia probably is a good pipeline, so to speak, for Canadian producers to benefit from. And ultimately, the goal for building these plants is to benefit and from selling your natural gas at higher prices versus having it stranded in Canada or selling it at very low prices to the oil sands users or the Canadians, right, where there's just not as much demand.
No, and so the alternative to not selling it to the Asians is that you have to sell it to either domestically or to the U.S.
Yeah.
And the U.S. has a lot of natural gas.
Yes.
And
putting tariffs on Canadian gas.
Yes.
Yeah.
So it's a meaningful opportunity for Canadian gas producers to, number one, get higher natural gas prices, but also diversify away from the United States that no longer necessarily needs as much Canadian gas as it did before.
And the world seems to be reducing its coal. Nuclear is an opportunity, but that's far away. In the meantime, of course, and we've talked about this on the podcast and everybody already knows this, the demand for electricity from plug-in cars, from AI, and then, of course, reducing the coal and what have you means that you need a really safe and standard fuel that can supply you 24/7 without brownouts and blackouts and what have you, right? And so unfortunately, solar and wind and hydro may be great alternatives, but they don't work for every geographic location.
Right, and you see that even in places like California, where in California, they've heavily built renewables. So there's a very large installation of solar there.
Of course.
But they still have to use natural gas because, it's not sunny all the time. They use natural gas through the winter and at nighttime. And it's really necessary for them to be able to, have a consistent source of power throughout the day, regardless of what the sun is doing.
And this AI demand for electricity and stable power is no joke, right? This is a real thing.
Yes.
Yeah. And even if we're using chips that require less power, it still seems that the demand side is going to be quite huge.
Yep.
And so reading in Canada and the United States, just all the amount of spending on these data centers. These data centers need to keep cool 24/7. You need to have the power on. And I guess these chips get very hot.
Yeah, I think we talked about this in a prior episode a couple months ago, where I think basically given the upcoming needs for power from data centers, from new LNG plants, not just in Canada, but in the US as well. And the fact that a lot of the major US natural gas basins are, declining in productivity, it's going to be quite good for Canadian natural gas going forward.
Very good.
From a pricing perspective.
All right. With that set up, we're going to talk about some specific companies. We're going to talk about Tourmaline and Canadian Natural Resources. They reported their Q4 earnings a couple weeks ago. Both announced dividend increases. Tourmaline announced a special dividend Tourmaline, both their stocks didn't perform that well in 2024, although they're doing okay in 2025. Versus, I think energies actually in the U.S. has been a very strong performer. I guess putting tariffs on foreign oil means U.S. companies have been benefiting as a result. But the results that we saw from both companies were excellent. And let's get into it. What do you want to start off with?
Well, I think an overarching principle for oil and gas companies that we look for is, oil prices are going to be whatever. It's not, CNQ can't control it, and Suncor cannot control it. Maybe the Saudi Arabian oil company can control it to some degree.
Yeah, more or less with the supply, yes, by OPEC,
But generally, they don't know what the price of oil is going to be. And we don't know what the price of oil is going to be. So we
do know what the economic price, the average economic price to get it out of the ground is, right, in specific regions. And if it falls below a certain level, that.
And even then, it's hard to predict. Because I've read predictions back in the day of people who say, well, this is the break-even price, and OPEC will never let it go below there, and it still does.
It
right?
still does, yeah.
It's very hard to know exactly what the price of oil is going to be, and I don't think it's a worthwhile use of time to spend too much time thinking about.
No, we Ernest and I do not look at charts trying to figure out what the oil price is going to be or look at technicals. We kind of model what our comfort level is for owning these stocks in terms of what oil, if oil is at this level, is that a reasonable, and what can we expect growth to be over the long term for Tourmaline when look at natural gas. But aside from that, we have no clue what's going to happen. Generally, price of oil and natural gas move up when the economy is doing better, or supply issues or demand issues, right? And so many other, and then of course these are also financial assets with people trading them.
Yep.
So it's so hard to figure out. We don't know. All we can tell you is what's going on today with oil. Oil is around $70 US. Natural gas is about $4 US, give or take. It was a colder winter, as everybody knows. So the demand for natural gas increased in North America. The price increased. The price for oil fell year over year as some of the Middle Eastern issues got quieter, less concerns there, as well as maybe a slowing economy and maybe the fact that high prices encourage more drilling. So still a pretty robust environment for oil and gas companies with oil at $70 and $4 natural gas. Pretty decent.
But I think what we care about is the things that the company can control. So are they being disciplined in how they're operating their business? Like, are they focused on, are they managing the cost structure efficiently? Are they deploying capital efficiently? Like, these are the kinds of things that we care about. And CNQ and Tourmaline have historically been the best in class at doing these kinds of things. That's why we own them.
Yeah.
And from time to time, people will ask us, well, haven't you looked at like this oil company or like this oil company?
Yeah.
And why would you pay up for CNQ when you can get like this junior oil company at like a much lower multiple?
Less glamorous name, but still, yeah.
And I think the answer to that is that, that little oil company might do really well. Like, I'm not saying it won't, but if you're studying companies from like a fundamentals perspective, I think it's really not about betting on like the price of oil. It's about betting on the quality of the asset. It's about betting on the management's track record to efficiently make money from that asset by, like being efficient with their drilling, making smart acquisitions and those kinds of things. And, I feel really comfortable that CNQ and Tourmaline have done that and will continue to do that in the future. And I don't mind paying a slightly higher price for them for that.
So we've owned CNQ we started buying it in 2022. We've done quite well on it, including total dividends. Yep. So we're pretty pleased with that. Tourmaline, we started buying in 2023, mid 2023. The performance hasn't been as good as CNQ.
On a stock price perspective.
Yeah, from a stock price perspective, of course. But stocks will do what they do. I think we're overall very pleased with the fundamentals and the cost controls and some of the actions that these companies have taken since we purchased the stock. And so no change to our thesis on what they're doing. In fact, probably some of our thesis is even stronger on the natural gas side, because in 2023 we did not see AI as being a huge consumer of natural gas.
Right.
Yeah. Okay. So
let's
be a little more specific.
Yeah. So I think the main thing that CNQ did, well, first of all, it expects to grow production by, I think it's 9% or something like that in 2025.
Okay.
Most of that's, coming from the Chevron deal that they did in 2024. But they also did a transaction with Shell in January. It didn't close yet, but where they basically swapped 10% interest. Well, they basically got the remaining 10% of the Athabasca oil sands property that they didn't own.
Okay.
They first bought 70% in 2014.
Okay.
So, no, it's 2017.
I wouldn't know.
They bought 70% of this property in 2017.
Okay.
They bought 20%, so taking that to 90% last year with the Chevron deal.
Okay.
And now they get the last 10%.
So they own 100% of this Athabasca oil sands project.
Yep.
Once owned in combination with Chevron and Shell, or just Chevron?
Chevron, Shell, and Marathon.
All right. So all the big super majors are out.
Yeah.
Are they essentially almost out of the oil sands completely? The
Shell still has some, I think.
and Exxon does through its subsidiary Imperial Oil.
I think Marathon is totally out. Don't quote me on that.
Yeah.
But I think this is a pretty good asset to kind of understand what CNQ's strategy is, because today the Athabasca oil sands properties there's two mines. They do about 310,000 barrels per day.
Wow.
This is up, I want to say it's up 70,000 barrels since they acquired it.
Okay.
So
up about, was that 30%?
So they've increased production by 25, 30%. And they've brought the cost per barrel down by about $10 per barrel. So
amazing. Very
very attractive returns on this deal. And bought at a time when Canadian heavy oil was not in favor, right? Remember in 2017 was the time when, the view was that Canada as an energy country was not going to do well because oil prices were weak. The U.S. had found all the shale oil, and they had no ability to move it to other markets.
So CNQ became the operator.
Yeah,
took control, and immediately, or not immediately, but over time, was able to increase production and lower costs. Something that their peers who were at the time joint venture weren't able to do.
Yep, and
so skin in the game really matters.
Right, and by owning 100% of this asset now, I think number one is that it allows them to, it gives them more share of their production that they're having from this mine. So increasing production without really increasing production.
Yes.
But I think more importantly is that by having full ownership, it really allows them to go in and apply whatever secret sauce they have in operating these mines to get the last penny out of every barrel that they're extracting.
One could expect more increased production and cost controls going forward. That's the CNQ secret sauce. They're able to wring out tremendous production growth over its lifetime and able to keep costs controlled. We've heard it many times before. So I mean, those are the two main reasons why we want to own CNQ. It's the management's ability to work their assets way better than their competitors.
They actually have an approval on one of the mines there to grow production by another 100,000 barrels per day. But, they don't have the ability to move it yet.
Yeah.
So the ability for them to ramp up is there. And not just in this property, but in, other properties that they have, including the Horizon mine.
Yeah. I mean, if the ability for Tourmaline and CNQ and others is just, there's a lot more production ability, but there's no infrastructure.
Yep.
And you also have to time it right. Do you build out production when oil prices are weak? I don't know, right? But here we are where prices have come off, and CNQ is, seems to be in a pretty good situation. Ernest, they did do some deals of course, we talked about this Athabasca thing. There was a few other things they did where the balance sheet is in a little worse situation as a result.
Yep.
But I guess over time that will look pretty good.
So they did raise the dividend,
Yeah.
but I think you'll probably see a little bit less buybacks in 2025 as they focus on paying down debt rather than making share buybacks.
And I think CNQ, if you buy it today, you're getting around a 5% dividend yield.
Yep.
And this is a company that we mentioned it before on this podcast. It's now 25 years of increasing its dividends. So 25 years of dividend increases. If you plot the chart of oil prices over the last 25 years, up and down like a toilet seat, a roller coaster. Yet here's a company that is able to grow its cash flow to shareholders, even in some very tough environments. And that's just a testament to the terrific management. And hopefully we can own it for 25 more years and they'll have a track record of growing its dividend over 50 years.
So it's a pretty simple investment thesis for CNQ, I think, because today the share price is, I want to say, in the mid 40s.
Yeah.
At $65 oil, they're going to do about $4 of free cash flow per share, of which you get about half in dividends.
Yeah.
At $75 WTI, they're going to do about $5 per share. So, roughly like 12% free cash flow yield.
Yes.
So, I don't know what oil is going to be. It could be $60, could be $80.
Okay.
But on average, you're probably going to get about a 10% free cash flow yield with the ability for CNQ to grow production into the future as well. So it doesn't seem to me that you're going to get a pretty poor result as a result of that.
So the demand for natural gas is quite clear, at least in the short to medium term, with AI and the electrification of the grid and the stable ability and closing coal plants and maybe some nuclear plants. On the flip side, when you do look at the demand for oil, and where is that going? Has it been pretty stable? A lot of people will say, look at how many electric vehicles are now on the road. Maybe if people buy fewer Teslas going forward. But the bottom line is, I think that's eventually, that's the way the world is going to move to eventually, is where we'll all have electric vehicles, I assume, in the next 5 to 10 years. Is that a real negative for oil price demand?
Well, no. I think this is a bit of a different topic, but
yeah, but we're going to get into it anyway.
So gasoline is a major component of energy prices, but it's not the only use of gas or of oil. Electric cars, I think the reality for electric cars is that I think if you look at the total amount of cars that are out there today, only about 5%, 5 to 7% are sold and churned every year. So even if 100% of car sales were electric today,
yes,
it would still take 20 years before all the cars were electrics.
Yes.
So, gasoline demand, and then even beyond that, like car demand is generally correlated with things like, population growth and general GDP growth. So it's going to be a while before.
And does that include all the commercial vehicles too, right?
Right.
That run on gasoline and diesel. Yeah.
Yeah. And that's another topic where for commercial, like it's even less likely that those are going to be replaced by electric vehicles in the near term.
So I've heard that from people as a reason why they don't want to buy oil is that they are worried about the long-term growth outlook for oil. Either climate change, which is a concern, or B, because of the movement towards more electric vehicles and less reliance on fossil fuels. But
yeah, I think one data point that is that kind of puts this to rest is that we've been talking about the decline of coal for a long time now, and coal consumption in the world is still higher than what it was 20 years ago. So
there's more people.
Yeah, so I don't think that
we just make too many people.
Oil is going to go away anytime soon.
Okay, so anything else you want to touch on with CNQ before you?
Yeah, I think one thing that is interesting is about tariffs, because we don't know what's going to happen on April the 1st or 2nd. I think 2nd, right?
Yeah.
We don't know what's going to happen on April 2nd.
April 1st, he didn't want to do it because he didn't want to be superstitious, apparently. Right. So move it one more day, yeah.
The previous proposal, I think, is that there's a 10% tariff on Canadian crude.
Yeah.
I think it was a little unclear who was going to end up paying for this tariff. Like, was it Canadian oil producers? Was it like the consumer down in the States that are buying Canadian oil? Like, is it the refinery?
Yeah.
I think what ended up happening after the tariff was announced is that differentials widened. So the difference between the discount for Canadian oil versus like U.S. benchmark pricing, so that widened. So Canadian companies are getting a little bit less on that.
Yeah.
But on the flip side is that U.S. benchmark pricing for Western Canadian Select also increased. So, like U.S. U.S. refineries are also paying more for Canadian oil. So I think net, and a few companies have talked about this, including CNQ, about half of the tariff, 10% tariff, is being paid by Canadian oil producers, and about half of the tariff is end up paying through higher pricing in the U.S.
And year over year, the Canadian dollar is down,
right.
So it may not be that material.
Yes.
To their. It probably is immaterial.
Yeah,
you won't even notice it on earnings.
So all put together, it doesn't seem like it's going to be a big deal.
Okay, well, that's good. That's puts some fears to rest for now. But you never know what changes can be made to the tariff rates or what happens going forward. Tourmaline also had a very strong year, very active year too for deals. I think it bought Crew Energy and Bonavista. Is that right?
Bonavista was 23.
All right. Well, yeah, I can't keep track of time.
They bought Todd Energy.
I don't know that one. And dropped down some more assets to Topaz, its subsidiary, its royalty play, as well as a busy year in terms of dividends and special dividends. It was kind of tenuous there. Natural gas prices in 2024 and 2023 were a little bit under pressure. Mm-hmm. Warm weather, just a lot of storage. Prices fell. I thought some prices fell to negative or close to negative. It wasn't.
AECO, yes.
Yeah.
For a Canadian benchmark.
But things have improved for the natural gas producers, and you can see it in their stock prices as well. So why don't you just do a quick overview of Tourmaline and what we expect for the next short term.
So I think the big picture for Tourmaline is that because they own all their most of their infrastructure, they have lower costs than their peers, so they're still making money even in a period of weak natural gas pricing. They do a lot of marketing of their natural gas in other markets, and they do a lot of very active hedging. So like a lot of the gas that they sell goes to like California, goes to, like other markets that are outside of like, Alberta AECO pricing.
Yeah. So they're benefiting. So when you talk about this Alberta AECO pricing, the price is very low.
Yeah, that's been kind of the weakest place to sell natural gas.
Yeah, we just have a lot of natural gas reserves and production in Alberta, and it's not a province that has 40 or 50 million people in it, right? It's just so the demand is not there. A lot of it does go to the oil sands too, but
yes, that's condensates. Yes,
yeah, of course. But the bottom line is our Alberta oil and gas companies would do better selling their products to other markets.
Yeah, so I think they have consistently realized prices for their gas at higher prices than AECO. And I think the real thesis for Tourmaline is that over the last couple of years, they've really consolidated a lot of the smaller, weaker financial players who just didn't have the capability to survive. The playbook is that they can strip out, they can sell a royalty on those properties to Topaz. They can go in and lower operating costs just by being better at those things.
So I assume there'll be multiple more deals to come then.
These things are kind of opportunistic.
Yeah, I guess so. Yeah.
They own all their facilities, so they can lower expenses there. And then the big picture is that with LNG Canada coming online, that natural gas pricing is going to go up.
So we might see that that Alberta price hit a higher benchmark level
Yes.
and stay there because there's just going to be a reduction of natural gas for Alberta and more going towards offshore and trying to take advantage of that. So it should benefit all producers.
And I think more interestingly, for Tourmaline's perspective, is that they have really scheduled up the timing of some of their plants and to ramp up production, and their exposure to AECO by not hedging their production to the timing of LNG Canada starting up and ramping up through 26 and 27.
I see that Mike Rose, as well as some other CEOs of energy companies, sent a letter to the government. Did you read about this?
No, I missed that.
Okay,
one.
yeah. So I mean, just more encouraging, like, let's get that infrastructure built.
Yeah.
What are we waiting for, right? Especially in times where there's concern that our closest trading partner doesn't want any of our stuff.
Yep.
Yeah. So it's how much of Tourmaline's energy or natural gas is sent to the U.S.? Is it a fair bit?
Well, it's a little hard to know like exactly because they sell it at the benchmark, right? Like you don't know exactly who's buying it from there. So it's kind of from their perspective, it doesn't really matter who is the end market. But in terms of tariff, like if I think where you're going with this is the tariffs impact to Tourmaline.
I am.
And the short answer is no. Like they would rather not have a tariff, but it's actually not that material because number one is most of the 10% is offset by weaker Canadian dollar. Mm-hmm. And then lastly, they expect that because most of the markets that they sell to in the US have no alternative supply sources. Yeah. So because California is not linked by pipeline to the basins, major natural gas basins in the US.
Okay.
It's likely that they're going to eat up most of the tariff anyways.
Okay.
Which is not really what you would expect if you're listening to Trump saying, we don't need any Canadian gas. Yeah. But that's the reality of it.
They need it. It's good gas. Take it. So with Tourmaline, unlike Canadian Natural Resources, it has been more dividend focused, right? CNQ is more focused on buying back stock.
Yep.
And now, of course, getting its debt under control. Tourmaline also did a number of acquisitions, so it is trying to reduce its debt a little bit, but it hasn't been a buybacker of its shares. Why does it matter for one and not the other? What would be your preference? I know I'm going off tangent here, but
I think Tourmaline has they have so the current capital allocation of Tourmaline is that they have a base dividend and they pay a special dividend on top of that fluctuates based on what natural gas prices are.
Natural gases are going up, prices are going up, and things are good. They'll pay out more in special dividends. If they're down, they'll ratchet it back or not pay a special dividend at all.
Yeah.
But they don't want to get rid of that base dividend.
Yeah.
That's not guaranteed, but it's something that they would be very hesitant to cut.
They do historically buy back stock from time to time. If the share price is trading below the present, like the quote unquote net asset value of the company, which is an estimate that they calculate based on like the amount of the reserves and what the current strip pricing is expecting for prices. And today the price is just not at that level yet. So I think they'd rather pay dividends and maybe even use their stock to make acquisitions of cheaper gas companies.
But it's very fascinating. You can watch the actions of the CEO, Mike Rose, who is very active buying shares of Tourmaline for himself, as well as I think a foundation that he runs. And he seems to be quite active buying when there's significant pullbacks. We see when the share price today is around $69, March 25. We've seen him buy back shares at $65 or lower. He tends to, when he sees that level pick up, it's something that he finds attractive. And I guess if you're getting a 5% dividend yield plus production growth plus all these tailwinds, you probably can earn quite a decent return on Tourmaline from here.
Well, it would be 2%. the
Yeah, the
2%
base dividend.
Yeah.
But
Okay.
I'm assuming that you get
Yes.
a
Yes.
total
Okay.
of 5% on special dividends
Right.
this year. Yeah.
Okay. Yeah. No. I think I agree with that.
Okay.
And
Fair enough.
Yeah. No. I think the reality is that Tourmaline is going to be like a little bit more volatile than CNQ because for CNQ you have like the oil sands project and it kind of have to maintain production throughout the time, whereas Tourmaline natural gas drilling is inherently like a more like quick turnaround type of decision that's you can flex up or down based on natural gas pricing. So like that's why that it makes more sense that CNQ is able to repurchase their stock, because they're not having to make these kind of snap judgments on pricing and really just focus on extracting value from that long-lived asset. Whereas Tourmaline's not kind of like that, and maybe have a little bit more near-term cash requirements in any given period of time.
So you expressed your enthusiasm for CNQ, given the free cash flow that you can see happening under the scenarios of the oil prices here. Do you share that same enthusiasm with Tourmaline at the current levels that stock is at?
Yeah, I like this stuff. Yeah, I think you pointed it quite well about the expected free cash flow that they're going to generate and the amount that you're going to get in dividends. And I think more importantly is that we're going to very likely enter a period of higher gas pricing with Tourmaline ramping up production into that. So I think the stock is very attractive.
And let's hope so. So I think that's all we have time for this week. Next week, Ernest, we're going to talk more Couche-Tard. Everybody loves talking Couche-Tard. They had finally turned it around with some decent results for a quarter, as well as there's more drama with the 7-Eleven, so we'll get to that. And I think we'll also do mailbags, so we'll ask for your questions, and hopefully we can answer some of those. So we bid you adieu, and we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.